Okay, let's unpack this. If you've spent any time tracking the development of the crypto industry, you know it operates in these big waves.
Huge waves, yeah.
We had the initial promise of pure decentralization, then the DeFi explosion, and now this sort of institutionalization of digital assets.
Right.
But based on the stack of sources you've provided for this deep dive, we are now looking at the next fundamental non-negotiable shift. And it seems to revolve entirely around confidentiality.
It's a transition that it really moves the focus from what is being built to how the underlying infrastructure is actually secured. I mean, for years, transparency was the default, the gold standard.
Everything public.
Exactly. But as the industry matures, the sources all confirm that Web3 is undergoing a necessary reconstruction where confidentiality moves from being just an optional feature to the absolute bedrock.
And that is exactly the mission of this deep dive, right?
Yeah.
Analyzing the data that predicts this massive inflection point. We're looking at a future where privacy has to be baked into the protocol layer to unlock any kind of true global utility.
It has to be.
And the central prediction is incredibly precise. The sources argue that 2026 is the pivotal year, the year where privacy becomes the core value proposition driving the next big capital cycle.
What's so fascinating here is really understanding the forces behind that timeline. This isn't just, some development roadmap. It's a convergence.
A convergence of what, exactly?
We have technological breakthroughs finally meeting the sheer practical demands of global adoption. As crypto finally starts moving beyond, let's say, decentralized speculation and toward being a viable foundation for things like global trade, real-world assets.
Real-world use cases.
Exactly. The demand for sophisticated confidentiality becomes immediate, unavoidable.
And this isn't just noise from, fringe privacy projects. This narrative is echoing through the traditional crypto establishment.
Precisely. We see this narrative reinforced in recent analyses from really significant players. I mean, we're talking major venture capital firms like A16s, key market intelligence providers like The Block. They're all signaling that the foundation has to be rebuilt.
And that rebuilding starts with what?
It starts with highly performant, compliant privacy.
So let's start there then. For the last decade, blockchain design, I'm thinking Bitcoin and Ethereum, it was all driven by maximum transparency, everything on a public ledger.
Right.
And privacy was often treated as this optional, almost fringe component. It was often associated only with projects that wanted maximum anonymity. But the sources are making it very clear that as the whole crypto ecosystem matures, that public ledger-only stances, well, it's unsustainable for any large-scale enterprise use. So why the sudden shift from optional feature to foundational requirement?
Because the market finally realized that if you want to be a global financial substrate, you simply cannot be a public bulletin board.
Good way to put it.
The shift is driven by three key parties: institutional participants, large enterprises, and crucially, regulators. An institution like a bank or a corporation processing supply chain data, they just cannot expose proprietary trading strategies or sensitive financial relationships.
Or customer PII.
Exactly, or customer PII to the entire world. I mean, competitive espionage alone makes that completely untenable.
That makes perfect sense. If I'm tokenizing a $500 million trade finance deal, I can't have my counterparty's negotiating position readable by every competitor in the market.
Of course not. The systems must offer a really critical balance: transparency and selective secrecy. The nuance here is so important. We need systems that can comply with legal and audit requirements.
So they can show what they need to show?
By providing specific data to specific parties when it's mandated, while at the same time guaranteeing confidentiality on proprietary logic or private inputs. This is why the sources consistently emphasize that privacy needs to be compliant, not just anonymous.
Right.
And if we connect this to the bigger picture, this blend is what unlocks the next wave of genuine real-world utility.
Okay, let's talk about that utility then, but through the lens of capital, of the market. So moving beyond the technological demand, we have to look at where the money is going. That often signals the true direction of the industry, doesn't it?
The momentum among investors is unmistakable. They really recognize the severity of this market friction.
The sources highlight a critical investor pivot. They're saying VC conversations are changing. While, novel tokenomics and yield still matter, investors are now increasingly viewing high-performance, compliant privacy as the next moat in crypto infrastructure. That's a strong phrase. What does moat imply here?
A moat is a defensible barrier, something that creates a persistent competitive advantage. For VCs, investing in a transparent Layer 1 chain today is inherently risky
Why risky?
because it will be perpetually excluded from high-value enterprise use cases. If you can't protect proprietary data, you can't capture the biggest clients or the most regulated markets. So the moat means the winning infrastructure won't just be fast, it will be selectively secret. They're trying to mitigate future regulatory and operational risk right now.
And this market shift isn't just happening in a crypto vacuum. It seems to mirror these massive existing trends in traditional tech.
Absolutely. I mean,
Yeah.
just think about the global political discussion around data ownership and digital sovereignty. Consumers and governments everywhere are demanding more granular control over who sees what.
Right.
So when that intense macro trend hits the highly transparent, immutable world of blockchain, the collision forces a fundamental technical solution. And this is why the sources feel confident putting a specific date on this transformation.
2026.
2026 is the year. The technology, the market readiness, and the institutional pressure finally converge to make privacy a defining infrastructure investment, not just a speculative theme.
So if the demand is clear and the capital's pivoting to find this moat, the natural question is, how have the underlying approaches to privacy actually evolved to meet this really stringent enterprise appetite? This kind of requires a quick history lesson on blockchain confidentiality.
That's right. We can trace really three major ways of technical approaches over the last few years. The first wave focused on just basic transactional privacy.
That would be the zero-knowledge proofs, right?
Exactly. ZK proofs were revolutionary. They allow you to prove a statement is true, like, I have enough funds to send this transaction, without revealing the underlying data. So the exact transaction amount or the sender's identity stays hidden.
But they had limits.
These solve basic transactional secrecy, but were not easily generalized for complex multi-party computations.
Okay, and the second wave?
The second wave introduced hardware assurances, such as trusted execution environments, or TEEs. Think of a T as a secure, isolated enclave inside a chip. The code runs secretly inside, guaranteed by the hardware itself. The downside: you're relying on hardware, which introduces trust assumptions about the manufacturer, and it's not always suitable for highly decentralized, permissionless environments.
So we have cryptographic proofs for simple transactions and hardware for isolated computing. What defines this current third wave that the VCs seem to be rushing toward?
The third wave is programmable privacy, composable privacy. This is where the secrecy itself is baked into the network's logic, allowing multiple parties to interact with private inputs and derive a collective, hidden result. This wave introduced powerful concepts like fully homomorphic encryption, or FHE.
Okay, let's pause on FHE because that's often framed as the holy grail of cryptography. Can you give us the simple version of why it's so complex?
FHE is incredible because it allows you to perform any computation whatsoever directly on encrypted data without ever having to decrypt it. You could add two encrypted numbers and the result is the encryption of their sum.
But there's a catch.
A huge catch. It is notoriously resource-intensive. Historically, running a simple computation using FHE might take 1,000 times longer than running it in the clear. It often required massive computational power just to do basic arithmetic. Powerful in theory.
But completely non-viable for real-time transactions on a scalable chain.
Yeah.
That sets up the problem perfectly. Enterprises need the power of programmable privacy, but they also need speed and performance. And this is where the sources specifically highlight a solution that seems to be overcoming that latency challenge: the application of garbled circuits.
Precisely. The sources frame the development and launch of networks like COTI, which is Ethereum's privacy-first Layer 2, as arriving at the exact moment the market's appetite for high-performance confidentiality just accelerates. It's an implementation of programmable privacy that bypasses the latency limitations of FHE.
Okay, let's define the mechanism at play here. Garbled circuits, GC.
Garbled circuits are a specific type of cryptographic protocol. They were actually developed decades ago and fall under the umbrella of Secure Multi-Party Computation, or MPC.
Okay.
Essentially, GC allows two or more parties to jointly compute a function, say, calculating a credit score or deciding if a complex trade contract is valid over their private inputs, without revealing those inputs to anyone, not even the other participants. They compute the result without ever knowing the secrets.
So it's secure computation on private data, but it doesn't have the massive overhead of FHE. This is where the specific performance metrics really come into play, and I think the claims in the source material are the core differentiator here.
They are absolutely striking. When CKI implements this GC layer on chain, the performance claims are revolutionary. The data suggests that garbled circuit computation is claimed to be 3,000 times faster than fully homomorphic encryption.
3,000 times.
And not only faster, but 250 times lighter in terms of computational load.
That comparison fundamentally shifts the discussion. You're moving from needing a supercomputer to run basic private logic, the FHE scenario, to making complex, real-time private computation economically feasible on a layer 2. That changes the entire economic model for enterprise adoption.
It moves the technology out of theoretical cryptography and into viable, scalable infrastructure, the kind that can handle millions of transactions, which is the necessary bridge to institutional buy-in.
So, this speed matters because it enables compliant privacy and real-world application, which brings us to our next section. But before we dive into the use cases, I have to introduce a point of friction the audience is probably thinking about.
Okay.
Historically, the moment you introduce compliance or selective disclosure, the ability to share data when required, doesn't that inherently introduce a trusted party? Or a centralized backdoor that governments or other entities could exploit? How do the sources address that philosophical tension?
That is an excellent and necessary question, and the sources are clear. The solution must be trustless. In the context of protocols like COTI's GC layer, the ability to grant selective disclosure isn't based on a centralized master key.
How does it work?
Instead, the disclosure mechanism itself is cryptographically guaranteed and programmatically governed. You define, in code, the specific criteria under which a specific piece of information can be revealed and to whom. Say, only to a regulatory auditor after they present a valid court order.
And the network enforces that.
The network enforces that logic, not a central operator.
So the system enforces transparency when needed, but the confidentiality is guaranteed by the math until those exact predefined conditions are met.
Exactly. And that level of verifiable compliant secrecy is what strategically positions the network for enterprise-grade applications.
Which sectors stand out as immediate adopters?
Well, the sources list several critical sectors that are not just interested in this capability, they are actively demanding this level of selective disclosure. For them, confidentiality is essential to their business model. It's not optional.
I'm guessing finance is top of the list.
The primary candidates are trade finance, which needs to protect sensitive contractual terms. Then there's real-world asset tokenization, RWA, where proprietary valuation methods or identity details need rigid access controls.
And outside of finance.
Healthcare data management, obviously, because of patient confidentiality. And sophisticated identity and credit scoring systems, where you need to prove eligibility without revealing all the inputs that led to that score.
Those markets are massive, regulated, and inherently data sensitive. They will never move on to Web3 without these kinds of privacy guarantees.
Never.
So, looking at the broader ecosystem integration, how do these new networks, like the one highlighted, anchor themselves in the existing crypto frontier?
They're strategically building on the most established foundation, security. The network is secured by Ethereum's massive proven infrastructure, so it leverages that established security base while simultaneously offering the sophisticated multi-party computation capabilities that these enterprise use cases require.
So it's not a siloed chain.
Not at all.
Yeah.
It's an extension of the existing ecosystem, just designed for privacy utility.
And the overall goal is ambitious: to provide the programmable privacy infrastructure for DeFi, payments, identity, governance, even complex AI computations, all of which require private, yet verifiable, inputs.
So what does this all mean for the competitive landscape moving into the rest of the decade? The sources summarize it perfectly. The industry is crossing the privacy inflection point right now. And those prepared with mature, high-performance solutions in this privacy-first utility space solutions that deliver speed, compliance, and developer accessibility like the claims we saw with garbled circuits. They will define the competitive landscape for years to come.
So the race isn't about being the most public anymore. It's about who can manage transparency best and most efficiently.
Ultimately, the analysis suggests a rare window of opportunity. It's created by this convergence of infrastructure readiness, immense market demand, and policy recognition that privacy isn't a feature for criminals, but a necessity for commerce.
Right.
As crypto finally matures beyond pure speculation, the winners of this next capital cycle will be those who have already built for compliant, privacy-first utility.
That brings us to our final takeaway for you, the learner. The key finding here is that the definition of privacy in crypto has fundamentally changed. It's no longer just about hiding. It's about controlling who sees what, ensuring compliance, and delivering performance at scale.
That's the trifecta.
Those are the essential ingredients for mass institutional adoption.
And the performance gap is closing dramatically. If these claims hold up, that 3000x leap in efficiency over prior methods, it just eliminates the primary technical barrier to real-time private computation that has held back enterprise use cases for years.
That leaves us with a provocative thought to chew on after this deep dive. If performance and compliance hurdles are now effectively solved by technologies like garbled circuits, what kind of traditional industry you think may be highly regulated fields like insurance or the complex multi-party world of global credit scoring? What industry will be the first to be fully rebuilt on a platform that guarantees both transparency and selective secrecy?
It's a fascinating question.
The foundation is being laid right now for the complete overhaul of those data-intensive legacy systems. Think about that potential.